All right, I think it has started recording. Okay, so I'll share my screen now. In the last class, we were talking about um basis of assessment, but we're unable to finish because of my cough. I'm really sorry about that. I'm still coughing, but I think I feel much more better. All right, so let's go back. We're going to be starting from the beginning. We are going to be starting from the beginning, and we'll try to at least finish this thing today. We'll try to finish this today because we have to have done it since last week, and we could not complete it. So yes, basis of assessment, right? I don't think this is a new thing to professional guys because you guys did it in skills. Either you did it in skills or it is theory. So this is not a new topic. It's probably not something you're hearing for the first time. But we just want to jog our memory because it's important that we remember this topic to proceed to other topics. It's important that you still understand basis of assessment. Okay, so now talking about accounting year. Accounting year is just the period that the financial statement of a particular company covers. Just like it can cover from January to December, from April to May, and so on and so forth, right? But the accounting period is the same thing as accounting year, but in case of a period, the time frame is either more than 12 months or less than 12 months. So the time frame differs. Unlike a year that is actually a year, like it's for 12 months. Whenever you see a particular financial statement that has period to of as at for the period ended this particular time. So when the word period is used in lieu of year, that means that that particular statement covers either more than 12 months or less than 12 months. So now we have year of assessment. Year of assessment is just the year in which the tax authority want to charge that particular business to tax. It is the year that you are to pay your tax or you are being charged to tax, something like that, right? And it's also the government fiscal year from January to December, the year of assessment. It's known as income tax year. Of course, that's like the definition. So assessable profit is the profits to be charged to tax. The profits that you are going to be applying your tax rate or tax percentage to is your assessable profit. So now let's talk about the linkage between the accounting profit and the tax profit or the assessable profit. So whenever we have our financial statement, in the statement of profit or loss or the income statement, we usually have profit for the year or net profit like below it. So that profit is called the accounting profit because it cannot be used for tax purposes. This is because there are some expenses that are allowed in the tax frame, sorry, that are allowed in the accounting realm, but disallowed in the tax frame that needs to be adjusted. So then you adjust these expenses, you remove the ones that are disallowed, you add the ones that are allowed, you remove incomes that are not taxable, and so on and so forth. And what you now get afterward is called the adjusted profit. The adjusted profit. So, but this adjusted profit is still based on the accounting period. It's based on the accounting year. And the process in which we now adjust the adjusted profit to suit or fit the tax year is the basis of assessment. That is where basis of assessment comes into place, right? We want to adjust this adjusted profit via timeline. We have adjusted it via allowable and allowable expenses to get our adjusted profit. But now we are concerned about the timeline because the time that the profit covers is not the time that we want to tax it. That's where we're going to be talking about preceding year basis and actual year basis, right? So now, when we make the profit, is not always when the profit is taxed. So in preceding year basis now, profit of last year will be taxed this year. Profit of this year will be taxed next year. That's why it's called preceding. In this case, we wait for the company to make the profits, then we tax them in the following year, right? It's easy to say, oh, in 2024 you made 10 million, so in 2025 you are paying this particular percentage of 4 million as tax, right? But in actual year basis, you are paying the tax on that particular profit in the year in which the profit was made, in that same year, actual year basis. So going forward, we are going to using PYB, AYB. I don't believe this is new. I want to believe it's not something that is new to you. It's something that is familiar, AYB and PYB. So we should note that assessment year from 2021 will be based on the Finance Act 2019, while years below 2021 will follow their own specific requirements. So what we are trying to say here is that Finance Act 2019 and other Finance Act that came after it actually had some effects. 2019 especially had effects on basis of assessment. So whenever you have a year of assessment, we call it YOA, or assessment year, of course, that is from 2021 upward. We're talking about 2021, 2022. Please note the word assessment year, not accounting year, please. Assessment year from 2021 upward. 2021 upward will follow Finance at 2019. But when we have 2020, 2019, 2018 assessment year, we are going to be using the law that we had before the Finance Act 2019. That's just what this note is trying to bring to our notice. So now let's move to the type of assessment. Please, if you have any question, you can just note it down, raise up your hand, or type in the chat box. So when I come back to Google Meet, I'm going to address it. Okay, so let me do this. We have the normal basis of assessment. The normal basis of assessment is a particular basis period that covers 12 months. It means that the number of years is complete. We have 12 months complete, right? But the abnormal basis is when that basis period covers either less than 12 months or more than 12 months. And there are certain situations or conditions that would cause an abnormal basis of assessment. And these conditions are commencement of a new business, change in accounting date, and cessation of a business. So we're going to be taking it one after the other. Like I said earlier, I don't believe this is new because yeah, we are professional guys now. This is advanced taxation, and we probably did tax before we move to the advanced level. So I expect that we are familiar with this already. Okay, so commencement of a business. When a business commences, that business cannot be categorized as an existing business. Like you cannot say that business has been existing because, of course, it has not been existing before. So now, and we have the how can I say this? The law that an existing business is to be charged based on preceding year basis. Before the Finance Act 2019, that law did not apply to a commencement of business until the third year of assessment, I think. Yes, the third year of assessment. But then now, 2019, Finance Act 2019 has brought a change to adjust that because the previous law has overlapping and gap, where there will be a particular number of profits or amounts of profits that will not be taxed at all, while some amount of profits will be taxed more than once, which is overlapping, right? The gap is when you do not even tax the profit at all. So that's why the Finance Act 2019 had to do something to it and ensure that like taxing people is fair. One of the canons of taxation is to be what's it called? Is this fairness? I think they've changed the canons too. But I know there's the fact that tax has to be fair, right? It doesn't have to do bad things to the business. And when you are taxing their profits more than once, you're already doing bad things to the business. Now let's talk about the new rule before we move to the old rule. We are focusing on the new rule. We're just going to be reminding ourselves of the old rule so that if you have any question that fall into using the old rule, it's not going to be difficult to understand. So now for the new rule, we have the first year of assessment. The assessable profit for the first year of assessment will be for the profit from the date of commencement to the end of the first accounting period. From the date of commencement to the end of the first accounting period. That's for year one. So now let's take an example. Please, everybody should unmute. So sorry, I said unmute. Everybody should mute their mic. Everybody should please mute their mic so that we are going to. Oh, sorry, I'm owing you. I'm the one speaking. I'm sorry. I guess my baby is disturbing. I'm really sorry for that. Okay. All right. So let me go back to. I thought I had a message. That's why I came here. So year one is from the date of commencement. ABZ Limited started business May 5, 2025, and its accounting year end is December 31st every year. Now let's take this as an example. We started with commencement, right? Commencement of a business. So now let's talk about ABZ Limited. That commenced when May 2025, and the year end is December every year. So now we have the year of assessment, basis period, and we have the what accessible profit. The accessible profit. So according to the new rule now, we're talking about the new rule. let me emphasize that. New rule. ABZ commenced business when May 2025, and the accounting year is December every year. Following the new rule, our first year of assessment is going to be what? From the date of commencement to the end of the first accounting year end. Since we have established that the accounting year end is what? December every year, our base period is simply going to be 1st of May 2025 to 31st of December 2025. And now, before, commencement did not follow the PYB until the third year. But after Financial 2019, we strictly follow preceding year basis. It means that the profit for this particular period is going to be charged to tax in the following period. What I used to do is that the year that this particular period ends must not show in your year of assessment. So now that this year ended 2025, the year that you are going to charge this profit to tax is going to be 2026. It's strictly on preceding year basis. It's strictly on preceding year basis. So I would be putting this on the Google Drive. Sorry, it's supposed to be use of assessment. So that's when we are through. Anyone that wants to have access to the Excel workbook would have access to it. Okay. So please, are we good with year one? So that's year one. Date of commencement to the first accounting year end. Now year two says that the accessible profit will be the profit from the second day after the first accounting period, the end of the next accounting period. So now this is as simple as saying, what is the second day after the 1st December? Of course, it's 1st January 2026 to the next accounting end. The accounting end is December every year. So we are still looking at December 2026. Now, the year of assessment, of course, is going to be the following year, which is 2027. I hope we are good. So now year three to eternity is saying that the profit from the second day after the last accounting period to the end of the next accounting period. This is simply just year two repeating itself, and that's how it's going to be. Simple. We are not omitting any profits, and we are not taxing one profit more than once. It's as simple as that. So year three is going to be 1st of January 2027 to 31st December 2027. So our year of assessment is going to be 2028. Yes. Please, I hope we are good.
Yes.
Any question?
Yes, you understand.
All right, thank you. So I guess you can move to the old room now.
Yes, ma'am.
I have a question.
All right, what's your question?
So my question is, so assuming you started business on the, let's say on the 12th of December,
Okay.
2025. And
Okay.
your year of assess and this thing, your accounting period always end 31st of December. So does it mean
Okay.
that you will provide financial statement for that 15 days?
All right. Thank you for the question. So usually, like I said, the accounting profit usually differs from the tax profit. And one of the situation that you have given is what makes it different. Because for the accounting guys, of course, they will not prepare financial statements for 15 days. Actually, let me hear what your yeah, take. So I'm sorry, I'm really sorry. So this accounting guys will probably they will not stop December 31st, 2025. They would want to stop in the next one, like December 31st, 2026, right? Because why would they prepare a 15 days financial statement? But what we, as because in this class, I regard to you guys as tax consultants. You guys are tax consultants. That is what I can expect of you in the exam, or you think like tax consultant, right? So now, as tax consultants, you'll be the one to now split the profit for them, which is what this basis of assessment is doing for us. Even if the company provides a 16-month financial statement, a 13-month financial statement, you will split it for them. So if you go by your example now, the basis period is still going to be 1st of December 2025. Oh, sorry, you said 12, Fabi. 12th of December 2025 to 31st December 2025. So now the company that now provides the financial statement probably did not even provide financial statements for this period. They would have merged it with the following year. All you now do is prorate. So out of they would call it December a month actually. So they would call it a 13-month financial statement. You be going to just do what 1/13. 1/13 of the particular profit that they made throughout the whole financial statement, and then that's it, you prorate. So then the following year, you now do January, 1st of January 2026 to 31st December 2026. So this one, the year of assessment is going to be 20. Sorry. So the year of assessment here is going to be 2026. Why this one is going to be 2027? Sorry. Please, are we good?
Yes, thank you.
All right, thank you. So now let's move to the old rule. Old rule for commencement. So for year one, year of assessment for year one is saying that the profit from the date of commencement to the end of that particular year. Profit from the date of commencement to the end of that year. So if though this particular example would not, but let's use this example like that, Sha. Let's use old rule. Let me copy this. Okay. So now we said the best way to do this old rule is first to list out your year of assessment. Like I told you, old rule did not follow preceding year basis on the third year. So now, if you look at the year that ABZ Limited started, it's 2025. So you recognize that year, 2025, 2026, 2027. Now, the first base period will now follow the first rule, which says from the date of commencement to the end of the year. They commenced 1st of May 2025 to 31st December 2025. Now, the second rule is saying that from the date of commencement to a 12 calendar month, which means a whole year, right? So what I do is to type out my months: January, February, March, April, May, June, July, August, September, October, November, December. So now to 12 calendar months, usually if a particular business starts here, is going to end the month after, I mean the month before. We should end here to start the month after. That's my own cue of doing it. But whenever I teach in class, I like to count. Let us count so that it's not be like magic. By the time we pick the end of the 12th month. So now, if the business should start May, just follow my green cursor. I hope everybody can see this cell that the cursor is. It has the green border. So just follow the movement and we count together, right? So we have May. May is the first month. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, which means that that's the 12th calendar month. So now our second year of assessment is now going to be 1st of May 2025 to, I think, April is 30th of April 2026. That is the basis period. So now the third year is now telling us that it should follow preceding year basis. If the business is yet to commence, then repeat year two's profit. So now let's talk about how that works. To follow the rule for year three using this old rule, we need to know the company's accounting year end. Yeah, we have the year end of December every year. If the financial statement is concluded by December every year, that means it starts January every year, right? So we have a January to December financial statement. So it means that following preceding year basis, the basis period for 2027 year of assessment is going to be 1st of January 2026 to 31st December 2026. Yeah. So this is it. I think in the last class there was a guy that was trying to correct me on this. Apparently the guy is correct. So because of what he said, I had to go back to my notes and like go and check out what he said and see which of us was right. And turns out the guy was right. I don't know if the guy is in this class actually, if he's in the class or not, but I did not catch his name. All right, so that's it about the old rule. Like I said, if you can notice now, for this old rule we have so much overlap. This May to December has been taxed twice because this May to December is still in this year too again. January to April is in year 3 again. We have so many overlapping and it does not encourage taxpayer. Why would I want to pay tax on a particular amount more than once? Which is why the new rule has to come. So why we have the new rule. So I hope we are good with this new rule and old rule. Can we move to example now? I'll treat one example. I'll leave the other example for us.
Hello, ma.
Yeah, I can hear you, Precious.
Okay. Please, I did not get that. The last one, that 2027, where you said
That's year
first
3,
of-
Abi.
Yes.
Okay, let's go over it again.
Thank you.
So what year 3 old rule is saying is that you follow preceding year basis. That's the rule for year 3. And to follow preceding year basis, you are going to need to know the accounting date of the firm. In your question, they will not give you accounting, though I doubt basis of assessment will come out for advanced people. You guys have too many questions than to see basis of assessment in your question. In fact, it's not possible, but you just know for no sake, right? So what we are saying is that if this business should end December every year, it means that it starts January every year. And that automatically means that the accounting period, the accounting year for this business is what? January to December every year. Now that is what you now consider in this year 3. So it means that profit of last year will be assessed to tax in the following year. Now, we already know our year. We have know that this is our year, right? All you need to know is that which profit will be assessed to tax in this 2027. No other profit than last year's profit. And you follow what? This accounting year. And ensure that the year, not that January to December is constant. It is the year that will change. you now put in the year that what goes with 2027 year of assessment, which is 2026. Are we good?
All right. Yes, ma'am.
All right. So let's work on this illustration 1. Let me copy it to the chat box. So XYZ Limited. XYZ Limited commenced business on March 1st, 2020. Makes up account to October 31st each year. So everybody, let's try this out. Put your answer in the comment section. Kindly use the new rule for the first 3 years of assessment. Oh yeah, let's do it fast. We are professional guys. We don't forget that we are tax consultants, and we need to be fast about everything. So new rule. Follow the new rule. Ria V, you did just 1 year of assessment. Oh yeah, I'm expecting more turn up. Okay. Oluwatoyin, you are right. Actually, you are correct. But this your last basis period. Wait. So you are right for the first. The second one, your year. Check this. Your October year is wrong. This one, same year, is wrong. And because these two are wrong, you got your year of assessment wrong. That's what affects your work. So try to check it again. Try to look at the law and check it again. Like that year is what is disrupting your work. Okay. Okay, I think somebody, you are correct with this, Mary Precious, but you wrote just 1 year now. What about other years? So Oluwatoyin, your first year is right. Remember, we are using preceding year basis. You are correct with this and this, but your year of assessment is wrong. For year 2 and year 3, your year of assessment is wrong. You guys are writing for only year 1 now. What about other years? Odusonya. I'm checking Odusonya as well. Odusonya, this is correct. From the second day after this to the end of the next accounting period, this is correct. If your answer is like Olusonya's answer, then you are right. Let me see. Feyi Shetan, you're also right. No, no. Omoyeni, your second one is wrong. You are right by saying 31st November 2020. You have, but your year end is not December 31st every year. It's October. So it's supposed to be November to October, not December. And because you are wrong with this now, your year of assessment, in the new rule, there is no overlapping and there is no gap. So it's not possible for us to tax, how can I say it, just a couple of months in year 2. That's not possible. Check it again and try. This person wrote just 1 year, but you're correct, Sha. Taiwo, you are correct. You are correct. Ogechuku is correct. You're also correct. This one, this place is the problem. November, this is supposed to be 2020. It's the second day after October. 1st of November 2020 to 1st of October 2021. This is 2020. Same year, this is 2021 to 2022. This is correct. So this is right, but this your beginning year is correct. See, now with this your analysis, you have left a gap of like almost a year sef. From November 2020 to October 2021, what happened to it? A whole year has been left untouched. A whole year has been left untouched. Emanuela, your hand is up. Let me hear what you have to say.
Yeah, good evening, ma. I feel you should like repeat what the new rule states. I think it will help everyone to understand it better because if they don't understand what the rule is stating, then there'll be a mix up in trying to get it. Thank you.
All right, I would do that. Thank you. I would actually I'll do the correct answer to the classwork that I just gave. I intentionally gave the classwork to know because everybody was saying that they understand. So it was intentional so that I would know if they truly understood or not. All right, so and time is well spent. So please let's just do the correct answer. So we are talking about XYZ Limited, March 1st, 2020 to October 31st. Let's move to XYZ Limited. XYZ Limited commenced March 2020, year end October every year. So now let me copy this. Let me use the one that is up that has the logo. Okay, so following the new rule now, we want to check the base period and year of assessment for the first 3 years. And the first rule says, from the commencement date to the end of the first accounting year. To the end of the first accounting year. So when did the business commence? March. 1st of March 2020. The first accounting year is what? I think October is 30 days. 30 October is still 20. Thank you. It's still 2020. It's still 2020 because we have October in that same year now. We don't need to go to the next year. So if you go to the next year, then your base period will cover more than 12 months. Because you are following preceding year basis, like I told you, the year in this particular base period must not show in this year of assessment. That means we are paying tax on this particular period in 2021. Now, the second year of assessment says the next day, after the end of the first year of assessment to the end of the next year of assessment is English. Honestly, we just need to break it down. After 30 October 2020, what is the date of the next day? If today now is 30 October, what is tomorrow's date? Is what? 1st of November 2020. We are still in 2020. We don't go to 2021. It's still the same year. You just need to say, okay, if today is 30 October, what is tomorrow's date? That's what your second year of assessment will start with. Then to the end of the what? Next accounting period. Remember, your accounting period is October every year, which means that your basis period will always end what? October. So we are back to what, October, but is it going to be 2020? No, because we only have 1 October in 2020, which we have used up here. It means that the next October is when? 2021. And because we are using preceding year basis, 2021 can never occur your year of assessment for that particular base period again. It has to be what? The following year. Please, I hope we are good. And of course, 30 October 2021, the rule says the next day after that particular period to the end of the next accounting year again. What is the next date? 1st of November 2021. Two, of course, we have used the only 1 October that we have in 2021. So we'll move to the next October 2022. And what year would that, are we going to tax this particular profit? 2023. Please, I hope we are doing good.
We are doing good.
Thank you, Mary Precious. No question. I believe there is no question. Okay. So if we are good, to put my mind at ease, let's do question 2. New rule, please. I'm placing emphasis on new rule because that's what I want us to know quite well. I don't expect that they will ask you old rule, but if you want us to do it, you can let me know. Personally, I'm focusing on new rule. Okay. This is last question, Precious. You do this new one that I posted to
Please, can you go back to the Excel?
Okay.
Thank you. I'm fine, thank you.
All right. Precious, this your year is supposed to be 2022. How many October do you have in 2021? It's just one now. So this is supposed to be 2022. Then if you correct this, you are going to be correct. Look, man, you can speak.
Yeah, good afternoon, everyone.
Good afternoon.
Good afternoon, everyone on call.
Good afternoon.
Yeah, please, I just joined the meeting. Please, can you start from the year of assessment, please?
We cannot start from the year of assessment. I'm sorry, because that will take our time and we don't have time. We must finish this material today. What
Okay.
I can do
Okay,
is
do you have another one? Okay, do you have any another one that you are going to explain to us apart from this?
Yes, this particular question that I just posted, when we are doing it, just listen up. And if you have question, I will answer your question by then.
Okay. Thanks so much. Okay.
You're welcome. So Precious. Okay, now you are correct. But nobody has tried this new question that I just posted. Somebody should attempt it now. We don't have time. There's no time.
Hello, ma.
Yes.
Can you please dictate the question you just put there? I can't see it very well on my distance. Sorry.
XYZ Limited commenced business on April 1st, 2020. XYZ Limited commenced business on April 1st, 2020 and makes up accounts to November 30 each year. Makes up accounts to November 30 each year. Determine the basis period for the first 4 years of assessment. Determine the basis period for the first 4 years of assessment. So that's it. I think somebody has dropped an answer. Okay, Chuku, thank you. You are correct. Let me give you thumbs up. Is there a way I can do emoji to this your thing? I don't think so. Oh, I would have loved to do thumbs up emoji to your answer, but you are correct. So let's see. Esosa. So okay, Esosa is also correct. Osagi, you are correct. Bukola, let's see. No, Bukola, you are wrong. You are wrong. Look at it again. Check the rule and look at it again. Omoyeni, let's see. Omoyeni Faith is also correct. So you should not look at your year 3. Year 3 is supposed to be 2021 year, not 2022. I guess that's a typo on your part. Every other thing is correct. Yeah, sit down like this. Emanuela is also correct. I think I've checked Ugochukwu before, okay, but you know put your 3 before. All right. I guess it's just one person that got it wrong, but let's do it together. Let's do it together. So for question 2, XYZ Limited commenced business April 2020, but makes up account November each year. Let's see. It's still the same person. Let's just copy and edit the information. They commenced business when April instead of May is what? April. And this one is now November every year. Now, using the new rule, and if anybody want access to this Excel, I'm going to be uploading it on the drive after class, so that if you want to watch the YouTube again and follow through with our solution, you have access to the Excel. But I'm only allowed to paste it on the drive. I cannot send it to the group. So now, the first year of assessment, now we have to do our base period first, and the rule says that from the date of commencement to the end of the first accounting year, right? They commence what? 1st of April 2020, and the first accounting year is going to be 30 November that same 2020, because we still have November in 2020 and we cannot skip it, right? So now the year of assessment is going to be what? The following year. Why? We are following preceding year basis. Don't forget, we are following preceding year basis. The tax of last year, the profit of last year will be assessed to tax this year. Profit of this year will be assessed to tax next year. That's what preceding year basis is all about. And the new rule strictly follows preceding year basis. So now, the next one says the following day after this accounting year end to the next accounting year end. So after 30 November 2020, if today is 30 November, what's tomorrow's date? First what? December
December
2020 to the next accounting. Remember, our accounting year is November, which means this base period must always end what? November. But it's the year that will now keep changing. So now we have 30 November 2021. Why? The only November that we have 2020, we have used it up here. So we don't have 2 November 2020. It can never be 2020, right? The next one will be what? 2021. And because we're using PYB, 2021 year must not show in this our year of assessment. It has to be the what? The following year. So we are using what? 2022 year of assessment, right? So following the third one, it still says the next day after this accounting year end to the next accounting year end. So we are just going to follow 1st of December 2021 to what? 30 November 2022. And the year of assessment is now going to be what? 2023. Doing the third one, the fourth one is going to be 1st of December 2022
and
to
30 November 2023.
exactly. And that's it. It's simple, right?
Very simple, man. You make it simple. Thank you.
Thank you. All right. So that's it about commencement. But please, you guys will have to give me 10 minutes. I need to pray. I've not prayed. Just 10 minutes for me to quickly observe my scholar and then I'll be back.
Are you not a Christian?
I'm a Muslim. Oh.
Well, the name is Onyinye.
That's not my name. The account is for the tutorial center. It's not my own.
Oh, okay.
I'm Pfizer. My name is Pfizer Jaji. Let me type my name for you. I'm Pfizer Jaji. Or you can call me Mommy Amotula. My baby's name is Ayatollah. Mommy Ayatollah. So,
Welcome.
in 10 minutes, please.
Hello, cannot hear anything again, ma.
She said she wanted to observe her prayers. She'll be back in 10 minutes.
Oh, okay. Thank you. Thank you.
All right. Thank you so much. I'm back. So I guess we're okay with commencement. We're okay with some commencement. So now let's move to change in accounting dates. Change in accounting dates. Let's go back to the material. So now change in accounting dates now. This just is a situation where a company believes that the year that they are ending their financial statement or their financial or accounting year does not favor them. Maybe most of the time when a company change accounting dates, it's just for tax planning. You guys are advanced tax, like I told you guys, you are tax consultants. You need to know what tax planning is. It's part of the modules. I don't think you've been taught. Of course, you just started class, so you definitely have not been taught. But tax plan is just a way of reducing your tax. You plan your account, your financial statement in such a way that you pay the minimum tax possible. That's what tax planning is about. So when companies change accounting dates, it's because they feel like that change will favor them and they will pay minimum tax, like So in this class, let me go back to Google Notes. You guys are tax consultants. That's why you see your ICANN question is as a tax consultant that works in XYZ accounting firm, you're expected to think like a tax consultant. So we started thinking from the class. We start to think like a tax consultant from the class. That's where we get to know if we understand the particular topic or not. So now as tax consultants now, your clients want to change the accounting date and they have come to you and say, oh, our tax consultant, please, we want you to have accounting date to what are you supposed to do? We have steps that you are going to follow. So for this change in accounting date, there's no new or old rule. No, this one did not change. It's the same thing as before 2019 Finance Act, and it's the same thing after. Do you get? So the first thing is to do what? Identify the first year of assessment when the change occur. I would like to rephrase this one and say identify the year of permanent change, which is what is here. Year of permanent change. Identify the year of permanent change. I think these are right. Let me put green. So identify the year of permanent change. The year of permanent change is the year that the company fails to close their account in the normal accounting date. Let me copy this and paste it to the chat box because it's very important. It's very important. Year of permanent change is the change that the company fails to close their account in the normal accounting date. So now, if we want to explain this, if a company usually, let me go back to our Excel sheet. Now, let's say 55, usually like ends the accounts. 55 year end is December every year. So, December 2021 year end, let's say they got 50,000 profits. December 2022, their profit was 70,000. We have to keep progressing now. December 2023, profit was 90,000. They now said that, well, that January to December, is not favorable for us as accounting year. Let us change. Let us start using May to April. So instead of ending in December in 2024, they just did April. April 2024. This, let's say 40K. April 2025, 120,000. April 2026, 150,000. All right. So now, in this scenario, the year of permanent change is the year that the company failed to use their normal accounting year end. What is the normal accounting year in December? Which year did they not say that, December, we are tired of December, we're not using December again, oh, let's use another year, oh. This is it. April. April is the what? Year of permanent change. So your first year, which is the year of permanent change, is now going to be what? 2023. 2024. Then that's it. That's it. So this will be your year of, let me put this here. Year of permanent change is now going to be 2024. So now this same example can come in this form. Let me copy this. No, I'm not pasting. I want to copy it like this. I don't want to move, I want to copy Jalo. Okay. So now, if this year now is not 2024 but 2025, 2026, 2027, what is the year of permanent change? Can somebody tell me? You guys are tax professional, don't forget.
Please, the question again. I didn't get the question.
So I'm saying that the normal year of permanent change, the rule is that the year of permanent change is the year in which the company fails to use their normal accounting period. And we have made this example. We have come to the fact that 2024 is the year of permanent change. Now, this year, no year is April 2024, but here is April 2025. So now, what is the year of permanent change in this particular scenario?
2024.
I'm coming, you know. So who said 2024? Precious Abby. So if you're Precious friend Abby, you want to follow Precious, type it in the chat box 2024. Sheton said 2025. So okay, Chuku, Blessing, you guys are following Sheton. You are for Sheton, you are against Precious, no problem. Look, man, how far you for Abby? You are against. Who are you for?
April 2025.
You are for Sheton, okay. You are against Precious. Precious, are you marking those that are against you? Okay.
I'm for Precious 2024.
2024, you are for Precious. All right. So, but looking at the scenario, actually, it's Precious that is correct too. It did not change in 2024 because we cannot, just because this statement now is for 12 months. This is for 12 months. This is for 12 months. How many months is this? It's more than 12 months. It's more than a year, exactly.
Exactly, yes, okay.
But in this case, we have 12 months as this place, but here is what? 4 months. That's just the difference between the two. This is a 4-month statement. This is like, let's say, I think 16-month statement. Abby? That's the difference. You do not want to raise a progress or do anything. This one is over 16, this one is over 4. That's everything. It does not change the fact that in December 2024, this company did not do their usual financial statement in December 2024. Instead, they used what? A different year end. Please, are we together? Sorry. Are we together?
Yes.
Do we get it?
Yes, ma'am.
All right. So let's move. If you have now recognized your year of permanent change, you have identified your year of permanent change. Please mute your mic, everybody. Mute your mic. Whose mic is on?
Lukman.
Oh yeah, who else is speaking? I think it's only Lukman. Okay. Let's go back to our rules. So we have identified our year of permanent change. The next rule says identify the next 2 years following the year of what? First year of assessment. I would have changed it to first permanent year of permanent change to make it more simpler. But you can note that year of permanent change. So now we have recognized 2024 as our year of permanent change. The next 2 years is going to be what? 2025 and what? 2026. 2025, 2025, and 2026. Please, do we get that? It's quite simple. Then the next
Yes.
step is compute the accessible profit using the old accounting date for 3 years. So it means that for these 3 years that you have recognized here, for these 3 years, you compute the accessible profit using December as the accounting year end. January to December. January to December. You compute it using January to December for these 3 years. Then the next one now says compute using the new accounting date. Then you compute using what? May to April. Compute using May to April for these 3 years again. What do you now do after that? Add up computation for the old date, then add up computation for the new date. You had the one that you did for December, January to December, you add that one up. Then you had the one for May to April, you also add that one up. Then what next? Select the higher of the two totals. Then you select the higher of the two, and that is it. The tax authority will now help you to say that it's the one that has the high profit that we want to, and that's what they are going to calculate your tax upon. That's it. That's it for changing accounting dates. Any question before we move to the what's it called? Any question? No question. So I assume that we all.
Hello, ma.
Do you have a question?
Yes, ma. The accessible profit using the old rule, which is old date, which is January to December, is it going to be
Yes,
based on preceding year basis or on actual year basis?
it's preceding year basis. Change in accounting dates is usually done by an existing business. The business has been existing before, it's not a new business. So you follow the PYB rule to the core.
What of for May to April?
That one too is PYB, preceding year basis.
Okay, good. Thank you, ma'am.
It's preceding year basis for the two. All right, so now let's move to the example that is in the PDF. So now Richard Tasty Limited for many years prepared account to 31st December. But in 2020, decided to prepare a 6-month account to June 30. So let me copy this so that you guys can be checking it out as we are. So did anybody volunteer to become class rep for this class? I don't think so. Did anybody volunteer last class? I think I asked for volunteers for the class. I need volunteer for class rep. I'm not sure if anybody volunteered. Please, if there's no volunteer, I'm still asking because I need help in collating questions for you guys. I want us to treat at least 10 years past question. 10 direct past question, I would say. So tax, they repeat questions. And if we're lucky enough that the question that we have done is what came out, then it's like a jackpot exam. Pressure, somebody's nominating you. Yeah, why did you nominate Precious? You cannot nominate yourself. All right, so while we deliberate on that, let's continue, please. So Richard Tasty Limited for many years prepared accounts to December 31st, but in 2020 decided to prepare a 6-month account to June 30. So the first you are required is to what? Identify the year of change. So my people, in this question, what is the year of change? Let me go to our Excel. So we are doing Richie Tasty, right? Richie Tasty Limited. Year of change. Okay. So what is the year of change? Anybody? Are we typing in the chat? My phone will die. I'm coming. Guys, the phone that I'm using to do Wi-Fi to my laptop is about to die. 1%. I'm coming. Please give me.
Hello, good evening, everyone. Please, can somebody explain to me what you said last, the last example, please? I didn't get that. Thanks.
Do you Do you mean permanent on cessation or on what? Sorry, on change accounting change on change of accounting date or
Yes, change
on
in
what are you?
accounting year. Yes, the change in accounting year. I went to it. I did not know she will come back before 10 minutes. Please help me. Thank you.
She said, "Can I continue talking before she comes?"
Yes, please. Thank you.
Yeah, you can.
Okay. She said, change of accounting date simply occurs when a company wants to change the date at which tax is being filed with the Nigerian Revenue Service or internal board of internal IFRS. So let's assume you have a company called XYZ Limited and you have been preparing your account to 31st June every year. So all of a sudden for 2021, 2022, 2023, you have been using June, 30th June. So all of a sudden you decide to use uh 30th October. Let's say 2021, 2022, 2023, you are using June. You are preparing your account to June. But all of a sudden, you now change to 30th October, 31st October. That 31st October, let's say you change in 2024. That is your permanent uh, year of change or year of permanent change. So having identified that, your year of permanent change, which is 2024. So you are now going to compute. So you are now going to identify 2 years after year of change. As in, year of change is 2025, for example. 2 years after year of change is then going to be 2026, 2027. Then you are going to compute assessable profits using old date, that is from January to December on preceding year basis. Then you're also going to compute uh, assessable profits using using new date, which is May to April, also on preceding year basis. Then you select which one is higher, the higher of the two. You are going to select. So the higher of the two, let's say if you when you use the old date, you get, let's say, 200,000. When you use the new date, which one from May to April, let's say you get 250,000. So you are going to select higher, which is that of 250. So that is how we apply year of our.
Sorry, from that 2026 and 2027, which months will you use? Which assessment period will you use? Is it from June, that old June that you have been preparing the account, or from the year that falls within that 2026, or from the year that falls within 2024? Sorry, did you get my question, please?
Yeah, I get your question. So from that 2020, from the year of permanent change, let's say the year of permanent change is 2025. Can you hear me? So from that year of permanent change, the total profit that your permanent change is 2025, then you identify 2 other years after that year of change, which is 2026, 2027. You understand? So if that year of change is going to be based on, 2026, 2027 profit will be based on preceding year basis. On preceding year basis. So let another person contribute.
Thank you very much. I appreciate it. Thank you.
You are welcome.
Please, I went off for a while to be sure that I'm the only one not hearing her yet.
I don't think she's back.
All right, thank you.
She's not back yet.
Thank you.
Hi guys, I'm really sorry about that. I did not pay attention to my phone. I'm sorry. So, in fact, I had to go and just look for an option to come back to class. I'm sorry. I don't know. Am I still sharing my screen? I don't think so.
No. We can't see your screen.
All right. Okay, I think I'm sharing the screen now. Okay. Sorry. So where did we stop? I think we were trying to do this illustration. Okay. So now we said, what is the year of change? In this question, which Tasty Limited for many years prepared account to 31st December, but in 2020 decided to prepare a 6-month account to June 30. 6-month account. So the year of change is going to be which year? So what is the year of change, guys? Or should I take it back to the question?
Please, can we see the question, please?
So this is the question. Which is Tasty? That is the question. So now, according to this question, what would our year of change? What is our year of permanent change?
2020.
Yeah, 2020. It's not 2021, it's 2020. 2020 is the year of change. Okay. So let's go back to our Excel. Year of change is 2020. So the next rule says that you should identify 2 years after. I think that's the first thing. Identify the year of change. Identify 2 years after. So years after is going to be 2021 and 2022. Okay. Yes. So now the next thing says compute the basis using the old and new dates. So now let's use old dates. So let me copy and paste our okay. So now using the old dates, we already have our year of assessment on ground 2020, 2021, 2022. And the old date is, let's put it out. Old date. Old date is December 31st. That is January to December. While the new date is June. So that will be July to June. So now we are using the old date, which means our base period will be based on January to December. Remember, change in accounting period follows preceding year basis rule. It follows the preceding year basis rule. So base period for 2020 year of assessment is going to be January 1, 20, so that will be 2019. 2019 to, so don't write it here. January 2019 to 31st December 2019. Let's assume a figure. Let's assume this year of assessment is 50,000. It's power. So it means that this one is going to be the second day, 1st of January 2020. So 31st December 2020. 4th of January 2021 to 31st December 2021. Now let's keep assuming figure. Let me make this 80,000 and 70,000. Okay. So now new dates. Let's copy this. Copy, paste. This one becomes new date. Sorry. New date is July to June. Our year of assessment remains the same. So, but the basic period is going to follow the new date that the company is now following. So now, using preceding year basis, what will be the base period for this new date? We are from 1st of July 2018 to 30 June 2019. Let's assume figure 600,000 to 60,000. I'll change everything to penny. So the second day after 30 June 2019, 1st of July 2019 to 30 June 2020. Let's say 90K. 1st of July 2020 to 30 June 2021. Let's say how much? 70,000. I'm not sure. Okay, so let's take this back to figures. Okay, so now after you have computed these ones, the rule says you should do what? Sum them up. Or equals to sum up. Let's bold in this. Or equals to sum up. Let's bold in this. So what would the tax authority do? They will choose the higher of the two. So now, out of the old date and new date, which one give us the higher accessible profit?
The new date.
The new date. So we are going to be choosing the new date. But you should note something. All of these ones that we have been writing since, they are workings. So let's shift them here. They are workings. Workings. So now the one that we now choose, which is the new date, is what you come and write as your answer in this place. Because we are choosing, let's write it there. Choose this because it is the higher of the two. Do you get? So that's it. That's it for changing accounting dates. Yeah, sit down. Please, are we good? Any question? I assume there is no question. So let's move to cessation. Cessation of a business also have old rule and it has new rule. Cessation of a business has old rule and it has new rule. So we're going to be talking about the new rule first. We talk about the new rule first, then we'll talk about the old rule after the new, because I told you we are focusing on the new rule, right? So now, for cessation of a business, it means a business wants to stop operation. The business no longer want to exist. It's no longer a going concern. They want to stop being in existence. So what do? They just want the backup. They stop operating, which means that that particular business will stop having profit, right? So now one rule applies to cessation. The rule that applies to cessation is that the profit that is going to be assessed for that particular company is going to be the profit from the beginning of the accounting period to the cessation date. That's why I put it in bolded figure. Profit from the beginning of an accounting period to the date of what? Cessation. Now, another rule applies to the year of assessment. For the year of assessment, normally we'll do PYB, but PYB is for an existing business, and a business that has ceased operation is not an existing business. I don't know if you get that. If the business has ceased operation, you can no longer call that business an existing business. So the senior basis does not really apply here. What we are now going to consider to knowing the year of assessment of a ceased business is when the tax is payable. Company income tax is payable within 6 months from the end of the accounting period, and that's usually like 30 of June. 30 June downwards. That's usually when accounting period ends, right? Or most period end December. Most period end December. So by June, you're expected to pay. So which is what we're now going to use to consider our year of assessment year two. So that is why any company that sits between January to June would pay their what? Company income tax in that same year, because their 6 months will lapse in that year. But any business that now sees from July to December will pay their what? Tax in the following year, because their 6 months will lapse in the following year and not that particular year again. Please, I don't know if you are following.
Yes,
Let me cite an example using the Excel sheet, right? So we have cessation of a business. Cessation of a business. So now let's give example. Let's say XYZ Limited. XYZ Limited is operation in, let's say, March 2025. And their accounting year end, oh God, need my glasses. The accounting year end is December every year. So now, if the accounting year end is December every year, and they cease operation in March, let's say March 30, the end, last day of March in 2025, what should now be their basis period and their year of assessment? Let me copy this. And paste here. Okay. Now the rule says from the beginning of the accounting year, if December is the end of the accounting year, the beginning is January 2025 to March 30 March 2025. Now, because if you count 6 months after March, I think we're still going to be like August, right? I think so. So it means that our year of assessment is still going to be 2025 year of assessment. I think we are okay with this. So now let's copy this and paste it now. Watch. So now let's change. The company did not cease operation in March again. Cease operation in September. So this company should cease operation in September. Nine. So if they should cease in September, would their 6 months still fall? Their deadline for filing their tax is going to fall in 2026, and that will be their basis, their year of assessment. Please, are we good?
Yes, ma'am.
All right, thank you. So, but for the old rule for cessation, we need to recognize what is called the ultimate year and the penultimate year. The ultimate year is the year of cessation, that is the year that the company ceased business. While the penultimate year is what? The year before year of cessation. Year before the year of cessation. That's the penultimate year. Then what you now do is that for the penultimate year, you compute the acceptable profits using preceding year basis, and you also compute using actual year basis. Then you pick the higher of the two. For the ultimate year, you do 1st of January to the date of cessation, that is actual year basis. 1st of January to the date of cessation, actual year basis. So now let's try that out using the same. So now let me put old rule paper this side. Old rule. Old rule. So copy, paste. Copy, paste. All right. So now, if they cease business in 2025, that means their ultimate year is 2025, right? And penultimate year is 2024, right? So now, you have to first choose. The penultimate year will come first. Penultimate year 2024. Using PYB, the basis period is going to be 1st of January 2023 to 31st December 2023. While actually the actual year basis is going to be the same thing, but the year is just going to differ. 1st of January 2024 to 31st December. Oh, sorry, I don't know. Yes. 31st December 2024. So now let's assume that the assessing profit for this one is 80,000. For this one is 90,000. So the higher of the two is what we are going to choose. So we are going to be choosing 90,000. Abi? I think I made an error in this. So then you're not going to do the penultimate year, 2025. That was 1st of January 2025 to the day that they cease, March 30 March 2025. And you write whatever figure, let's say 50,000. And that's it. That's it about the old rule for cessation. Please, are we good to go? Do we get the old rule and the new rule?
No, ma'am. Please, I'm still confused.
Can you take it back to Excel sheet again?
New rule, please, ma'am.
Is it the new rule that you're confused, or be the whole rule?
The new rule. I don't. Why did you start with January until trying to figure out your reason of starting with January.
The reason why we started with January in the new rule is because that the accounting year of the company is January to December every year. And the rule says from the beginning of the accounting period to what? To the date of cessation.
Okay, ma'am.
Any other question?
Hello, ma. Sorry, ma.
Okay, I can hear you.
I don't actually get both the new and old rule. Like, it's kind of complicating to me.
Okay, let me go over it one more time. So let's start with the new rule, right? This is the new rule here. The rule says that, let me go back to my PDF. Let's ignore this old rule first. Let's come to the new rule. To know the profit of the business that have ceased for a particular year of assessment, it says that you should assess them from the beginning of the accounting period to the cessation date. I intentionally bolded that particular sentence. Beginning of the accounting period to the cessation date. Now, let's go back to the Excel sheet. This company ceased operation. I think my ceased has comma. This company ceased operation in March 2025. So if you want to follow the rule, and they say that the accounting year is December every year, it means that the accounting year was January to December every year. So if you follow the rule, it says the beginning of the accounting period to what? To the date of cessation. Is very simple. But now, how do we now get the year of assessment that we are going to use? The rule says that you need to consider whether the business has ceased between January to June or between July to December. And if that will help you to determine whether your year of assessment will be in that same year that they have ceased business or the year after they ceased business. Now let's analyze that. January to June means that they can still pay tax in that same year. If the business ceases in, let's say, April, which is in between January to June, right? April, if you count 6 months after April, we are still in that particular year, which means the deadline for paying their own tax will fall in that year, and that year will serve as their year of assessment. If this is in June itself, deadline for paying their tax will be December, so they still pay tax in that year. But moment they cease in July, deadline to pay the tax will be January the next year. The next year will be their year of assessment, which is what we have experimented in this place. In this particular one, they cease in March 2025. That's why 2025 was their year of what? Assessment. But in this one, they cease in what? September. 2026 becomes their year of assessment because the 2026 is their what? Is their deadline for filing and paying what? Tax. Are we good now for this new rule?
Yes, ma'am.
All right. But for the old rule says we need to recognize our ultimate year and penultimate year. So for this old rule now, this one is the what? Penultimate ultimate year. Because it is the year before cessation. Penultimate year is the year before cessation. While ultimate year is the year of cessation. Ultimate year is the year of cessation. This is the ultimate year, so 2025. Ultimate year is 2025. Penultimate year is 2024. We are still using this same illustration. This one that is here. The same illustration is what we are still using. Okay. So now the rule says that for the penultimate year, you do actual year basis and you do preceding year basis. Then you choose the higher of the two. But for the ultimate year, you follow actual year basis, which is almost the same thing as this actual. No, 2019 scrapped out penultimate year, blah blah blah. It only left the ultimate year. So we are saying that you first do preceding year. This is, let me, I don't know. Okay, let me put this here. PYB. This one is the preceding year basis, and this one is the actual year basis. Then you now pick the higher of the two. Preceding year basis means tax of last year will be assessed to tax. Profit of last year will be assessed to tax this year. That's why we have January 2023 to December 2023 in this one. But here that we have 2024 and our year of assessment is also 2024. is where we use the actual year basis. But because the money for actual year basis is more than the preceding year basis, we choose the actual year basis as what? Our basis for what? For this particular profit. Then ultimate year will follow actual year basis, which is profit from the beginning of the year till the date of cessation. So that this will be your profit, accessible profit. Please, are we good? Any question? No question, I guess. Okay, so in this PDF we have questions. We have, I think, 4 illustrations. Okay, I don't even know that the okay, let's do this. The answer to number 1 is already there. Let me type this on the group and let's just take this copy. I'm coming. Let's try this,
No,
everybody.
hello, ma. Hello, ma.
Yes, I can hear you.
Okay, I want to now. I understand the first year for both old and new, but all I say, how the second year for the new rule. So how will it look like? Are we going to do the previous
There will
year
be no
or the new
second
year
year
going
now. The
forward?
business has closed. The business has closed.
So
There's
it's
no
only
second year.
so it's only that one year that we are doing.
Yes.
So we are only doing the ultimate year.
Oh, yes. Just 1 year. But there's nothing that you want to tax again. Shey you want to tax business that is not in operation.
Okay.
That's the rule now. That the new rule is very simple. That's what the new rule says. You stop at the ultimate year. So, Ugu Nigeria Limited, that was incorporated in 1990, ceased operation in March 31st, 2020. Having been in business for over 25 years, the accounting year end of the company is 31st December annually. You are required to determine relevant years of assessment and due date of payment of tax. So everybody please use new rule and tell me the basis period and year of assessment of Ugu Nigeria Limited. Oh yeah, quick. My tax consultant, what happened? They have not given me any answer. Year of assessment is 2020. Okay, what about the basis period? Okay, I guess Obikiola is correct. Manuela is also correct. Ah, 1990, Bitibawo, Adetunji. How many years do you even want to? I don't understand. How many years did this your basis period contain? Come on.
So it's a mistake. Out of that 2020, it's a mistake. Sorry.
Mo fẹ́ sọ wípé this your own tax consultant mama help government ìpawó wọlé. Okay, so I guess everybody have gotten this new rule. It's actually quite easy. So, do you want us to try the old rule or we can just move?
Let's move.
Let's move. No need of Odoo since we're not
All
using it.
No, we're not using it. So, any subsequent receipt or payment after cessation are treated as paid or received on the date of cessation. So it means that after the particular company have ceased business, maybe one of their debtor that was owing them decide to not pay afterwards. Of course, government is expecting you to treat it as if you receive that money on the dates that you cease business and still pay tax on it. I hope we are good. So for this one, there are some things that a company that want to restructure is among the related party. There are some exemptions for them on this cessation and commencement. When there's business restructuring, especially among related party, let's say for example, let's say XYZ Limited as like associates or subsidiaries that engage in different lines of business. Let's say some food, some children wears. Come on, let me hear. Some food, some children wears, some adult wears. So they now decide that this food that is there is not bringing in much money. We want to turn all our subsidiaries and all our related parties into wears. So now we already have children wears, I already have adult wears. So what we'll now do is that the adult wear will separate it into two. Let one handle female wears, where let the other handle male wears. So the one that is not doing food, they now gave it male wear. You know that some part of the adult wear are seized, while the food also seized, and the male wear like kind of commenced. But in that case, since they are related party, we're not going to treat them as commencement and cessation. So that's what one of the things that finance have brought. They are going to be exempted. But there are some rules or there are some conditions for them to be exempted from this. Number one is that these companies must have been rated for at least 1 year prior to the restructuring. So because, like I said, there's something called tax planning, which you guys will learn in this advanced tax. Sometimes companies can use this for tax planning. They will become related to another company within the year they start restructuring so that they can like enjoy some exemptions. But tax authority if your relation is less than 1 year, it's not up to 1 year that you guys are related. You have started restructuring one nonsense restructuring. You are not going to be exempted from this rule. So another one is that there must be no disposal of assets post restructuring until or after 1 year. So you're not going to be selling your assets until after 1 year of the restructuring. So if you decide to sell, they're going to withdraw your exemption, and of course the commencement and cessation rule will apply. Then there will be no VAT, no CGT on disposal of assets among related party during the business restructuring. So that's all. Illustration. Please, if you have the material, you can go through this. If you have any question, come to my DM. I don't think we need to. My battery. I don't know why is today like this, Why? But let's continue until this laptop finally dies. Let's move to the next topic, please. So we are going to be talking about something that you have known before. And I'm coming. I need to open another one. I want to upload module 2 so that even after this class, I know we'll certainly not be able to finish this, or well, in fact, I'm not really sure. The highest this battery will go is probably 7 p.m. So what we'll do is that if anybody wants to go through what we have done and even want to exceed what we have done, you can go through it. You see it on the drive, then you can read it and go through it after the class. No, because after today we are meeting next Sunday. So what we're going to be talking about is capital allowance. Not going through now. It's just rolling. Yeah, let's continue our work till we decide to go through. So now, we all know the concept of capital allowance, and the main concept is that it replaces what accounting depreciation, which is a disallowable expense in the tax depreciation for tax planning. They adopt the method of depreciation that reduces their profit. And because of that, the tax authority decides to disallow depreciation and bring forth their own form of depreciation, which is called capital allowance. So that's just the major thing about capital allowance. Let me go and check the mail again. If we go into this lecture, we might end up forgetting and we'll not even remember to. Let me close this up. So so it's there after class and you need access to it. There it is for you. Now we're about to capital allowance. So types of capital allowance now. We have just 3 types. We should note that Finance Act, I think either 2021 or 2023, one of the two, I'm not really sure, has removed investment allowance, because I'm very sure that we did investment allowance in our taxation. Or maybe some of us did it, but it is no longer there. Investment allowance is no longer there. Now let's pick it one after the other. We have capital allowance, initial allowance. Initial allowance is granted in the first year of acquisition of the assets, right? So the year that you got the assets, whether it's new asset or second hand, the fact that it's second hand, as long as the second hand is not via business restructuring or from subsidiary or a parent, there's a particular chapter that deals with these things. I think merger and acquisition, I'm not really sure. So that particular chapter will tell you how to treat capital allowance, loss relief, CGT VAT, withholding tax in different type of business scenario, whether partnership, business restructuring, parent subsidiary, merger and acquisition. Merger is from acquisition. So that particular chapter is very important because these are written chapters, but in the questions that you are given in your exam, the knowledge of those written chapter will be required to calculate those calculation aspects. If you don't know, for example, the business that they give you might be a company that has merged with another company or a company that has acquired another company. If you don't know how to treat capital allowance with a merged company, a bit of a merged company or of an acquired company, you might end up doing the wrong thing. I don't know if you get what I'm trying to say, Sha, but you need knowledge of that particular chapter. And also tax incentive. Before it was chapter 12, but now they have changed everything. I don't know what chapter it is currently. Okay, so I was talking about initial allowance. It is granted in the first year, the year that you purchase the assets, whether it's new or second hand. And it is granted in full, regardless of the number of months in your basis period. So it means that even if your basis period covers a month that is less than 12 months, you see, like, you don't prorate initial allowance. You don't divide it into because it's 9 months that is there, 9/12. No, you don't do that. Even if it's 4 months that is there, you give it the whole year. The initial allowance of the whole year is going to be attributed to that asset. You don't prorate initial allowance. So now this professional guide is for, because I use this material for skills guys too. So, but this information is for you guys only. So in respect of plant and machinery, if you replace plant and machinery for old ones, one of 95% capital allowance in the first year shall be allowed. This one is for, let me go to this place, we'll see it. The 5% book value shall be retained until the final disposal of the asset, provided that the aggregate capital allowance granted in the respect of any asset shall not exceed 5%, 95% of the total cost of the asset. But let me go to this capital allowance rate. What we're talking about is here. Okay. So you see this rate that has 95% nil, 95% nil. These are the ones that your initial allowance is going to be 95% and no annual allowance. But when you're ready to dispose the asset, the remaining 5% will now go. So when you replace, where is it called? When you replace plants, it falls under that category. So that's just for that information. Now, annual allowance is like the name connotes, it's annual, is every year. And it is computed on the residual balance after you have removed your initial allowance from your cost. So it means before you can compute annual allowance, especially the first annual allowance, you need to what? Find the balance of your what? Cost minus initial allowance. Then on the remaining amount, you calculate your annual allowance percentage, or you use your economic useful life. EUL means economic useful life. So for annual allowance, we prorate your annual allowance that you are going to is it accept, what should we say, that you are going to use. It has to tally with the basis period. So if your basis period is not up to 1 year, you are going to prorate your annual allowance to what? To the number of months in your basis period. I hope we get that. So there are 3 formulas for annual allowance. 2 can be used in place of one another. It's mutually exclusive. If you use one, you don't need to use the other one. But the remaining one, the third one, is used when you either don't know the cost. Maybe you were not told the cost of the assets, you were not told, or the annual allowance that you are computing for is not for the first year. So now the first one, we're talking about cost minus initial allowance divided by the economic useful life. How will you know the economic useful life of an asset? Because they will not give you the economic useful life. What's the ICAM question will give you is what? The annual allowance percentage, which will make this one a more preferable option for a lot of people. Cost minus initial allowance multiplied by the annual allowance percentage. This is what most people use, right? It's easy for most people. But to know your economic useful life, go back to your rates, annual allowance rate. Let's take building number 1 as example. The annual allowance percentage for building is 10%. So now know the number of years, the useful life of building. All you have to do is say 100% divided by 10%. 100% divided by 10%, and that is 10 years. For, let's say, this industrial plant expenditure, that's 25%. 100% divided by 25% is what? 4 years. Let's go to this furniture and fitting. 100% divided by 20% is what? 5 years. Please, are we still together? Are we still together?
Yes, ma'am.
Yes, ma'am.
Right, thank
Yes,
you.
we're together.
I know this is going to be a bit boring because it's something that we know before. We are just trying to jog our memory so that, because by the time we start getting into real calculations now, if we don't understand or remember your capital allowance, it's going to be a problem, and we don't want problem in the future. So that's why we still need to go through this. So yes, that's the economic useful life. And to use this third formula, you need to know your tax written down value divided by the remaining economic useful life. So the tax written down value is simply your carrying amount in the tax realm. No, in accounting, you say cost minus accumulated depreciation will give you what? Carrying amount. But in tax, you do cost minus what? Annual allowance minus initial allowance, you give it tax written down value. So now in a situation whereby you want to compute the company income tax of a particular company, and it's not a new business, it's an existing business, and they give you the tax written down value of the assets, because of course it's not the year that they bought the asset that they are computing for. It means you do not have access to the cost of the asset, but you have access to the tax written down value. What you just do is to know the economic useful life, remove the number of years that they have used before, know the remaining economic useful life, and divide to get your annual allowance, and that's it. So we have the balancing adjustment allowance. This arises when what? The company sells their assets. So when you sell the assets, they can either make profit or make loss. When they make profits, they have to pay tax on that profit, and that's where balancing charge come into place. Balancing charge. So balancing charge occurs when the tax return value is lower than the sales proceed. Tax return value is lower than sales proceed. Balancing charge will occur. This, I'm sorry, I spilled something. Okay. So, but balancing allowance occurs when there's a loss, and that's why it is an allowance. Like it's like a loss relief, something like that. Sharp. It's an allowance. They allow you to remove it from your profit. So, and that's where your tax return value is higher than the what on the sales proceed. It means that what the asset is worth is more than what you have sold it for. It's worth 50K, you sold it for 30K, 20K loss. That 20K becomes your balancing allowance, right? But for balancing charge, the tax return value is 50,000, you sold it 70,000, you made a profit of 20,000, and that's what you're going to be charged upon. You're going to be adding it to your taxable income, and it's going to be taxed. So now there's like a caveat to this balancing charge. The balancing charge, which is the profit on the transaction, must not exceed the total capital allowance claimable on the assets before disposal of the capital expenditure. Now, let me explain that. So what we are trying to say is that you bought the asset 500,000. As when you sold the assets, the tax written down value was 250,000, which means that you have like collected 250,000 capital allowance on the asset before you even try to sell it. Before you try to sell it. So when you now sold the assets, I don't know the type of person that bought the asset from you, but the person bought it 600,000. So it means that you made a profit of how much, self? That's like 350,000 profits on the assets. On the norms, the balancing charge is supposed to be 350,000. You are going to be taxed on 350,000. But because of this caveat, you restrict that balancing charge to 250,000 naira, which is the total capital allowance that you have charged or you have claimed on the asset before disposing it. Please, are we good? Before we move to the next subtopic under this. Okay. So let me talk about the restriction again. Because I think I've seen them test this restriction. I cannot remember the year of the diet in the past question, but I've seen it before. But just once, I don't know if I've repeated the question, but I've seen it before. So now what we are saying here is that your balancing charge must not exceed the total capital allowance claimable on the assets before you dispose the assets. The balancing charge that the government will tax you on, remember, but balancing charge is a profit to you, and your profit will be what? Tax. The profit that you have earned from selling the assets. And now, when I say that profit that they will tax you upon must not exceed the total capital allowance that you have claimed on the assets before. Let me go back to my example. You bought an asset 500,000 naira. By the time when you sold the asset, the tax written down value of that particular asset was 250,000, which means that you have claimed capital allowance of 250,000, right? But now when you sold the assets, you sold it 600,000 naira. It means that you made a profit of 350,000 naira on that particular asset, which is supposed to be your balancing charge straight up. But because of this restriction, your balancing charge should not exceed what? The total capital allowance that you have claimed on the asset, which means you are not going to restrict that 350,000 to 250,000 naira. So in your CIT computation, your balancing charge will now be 250 instead of what? 350. Do we get it?
Yes, ma'am.
All right, thank you. So I don't know why is this class reducing? Because we're talking about capital allowance. Okay, No problem. You guys have known it. All right. So let's
Not
move.
all.
You said
I said not all of us, because this last one, that what was the example you made? I didn't get the figures correctly, so I'm a bit lost.
okay. So I said that the cost of the asset is 500,000. You bought the asset for 500,000 naira, right? And then you sold the assets. But as when you sold the assets, the tax written down value of the asset is 250,000. Remember that tax written down value is what? Cost minus the what? Total capital allowance. It means that you have claimed capital allowance of 250,000. Don't let me use 250,000. Let's say the tax written down value is 200,000. You bought the asset 500,000. Tax written down value is 200,000. It means that you have claimed 300,000 naira as capital allowance before you sold the asset. So now you now sold the asset for 600,000. Like, I don't know the type of person that bought the asset from you, but the person, maybe the person don't know what is doing, but the person bought it from you for 600,000. It means that you made a profit of what? How much? 600,000 minus 200, 400k. You made a profit for 400k from the asset. That is the sales proceed minus what? Minus the tax written down value. Sales proceed minus the tax written down value will give you your balancing charge, right? And balancing charge is supposed to be 400k. But because of this restriction, it says that your balancing charge should not exceed the total capital allowance that you have claimed on the asset before. So, and before you have claimed what? 300k on the asset as capital allowance. It means that you restrict that 400 profit to 300,000, and the amount of balancing charge that you show in your company income tax computation will be 300,000 and not 400,000. Please, are we good? All right.
That's the
Thank
less valid.
you. Okay, let's fire on because this battery is going down. So we have qualifying capital expenditure. These are just the expenditure that qualifies for capital allowance. Like we have the plant and machinery, the building, mine, plantation, R&D, agricultural plants, motor vehicle, software as well. Any expenditure that is an allowable deduction in computing the profit of a company's trade or business in accordance with the provisions of CETA shall not be treated as qualifying expenditure. Now, what they are trying to tell you here is that an expenses that you are going to remove in your CIT or that you will remove in CIT, like it's an allowable expense, cannot be an asset. Because even in CIT, one of the allowable expenses was capital expenditure. Capital expenditure is an asset, which is going to follow that company income tax. You do capital allowance on it. And a normal expenses is not an asset. So you're not allowed to do capital expenditure on a normal expenses. I hope you understand that. So note, when a building is purchased, the relevant interest to the company making the purchase is the original cost of construction of the building or the price paid for it, whichever is lower. If the building is purchased second-hand, no initial allowance can be claimed by the purchaser, but annual allowance can be claimed based on the amount of relevant interest as defined above. So this one is just saying that a company bought a building. Of course, you know that building is not shoe. Building is not bag that you buy as ready-made. Somebody did what? Somebody built it from the scratch. You did not import the building. It did not come from Japan and be Spain. Somebody in Nigeria that came and built that stuff. So we're not saying that what the tax authority is trying to do here is that if you are stupid enough to overpay, let me use the word overpay. If you are stupid enough to overpay for the building, that's your loss. Because if you overpay, they will consider the original price of the building, the original price of constructing the building. That's why they're saying that whichever is lower. If they spent 5 million in constructing that building and you bought the building 6 million, that's your loss because we picked the lower of the two, which is the 5 million that they used to construct the building. And that's what your capital allowance computation is going to be based on. I don't know if you get it. Please, do we get that? All right, thank you, Adetunji. So, if the building is second hand, that no, that remember that when we're talking about initial allowance too, it has been put in brackets that exception is building for second hand asset. No initial allowance for second hand building, because the original owner of the building will have collected initial allowance for that particular building. Do you get? So no initial allowance for second hand building. Now, conditions for granting capital allowance. We don't just grant capital allowance. There are conditions, or should I say, there are conditions like MTN will say terms and conditions apply. Before you can say you want to collect capital allowance or you want to claim, yes, claim is the word, claim capital allowance. So these are the conditions. Number one, the taxpayer must own the asset and use it rarely, reasonable, wholly reasonable, exclusively, and necessarily for the what? Trade or business by the basis period end or by the end of the basis period. So it means that the company that you want to claim capital allowance for must be the owner of the asset, and they must have been using the asset as at the end of the basis period. Sorry. So you cannot claim capital allowance for an asset that a company do not own. If the asset is not for the company, then you cannot claim capital allowance for the asset. That's number one. Allowances are applied against accessible profit of the tax year. What we are trying to tell you here is that it's not possible to claim allowance when you have a loss. You cannot claim allowance on accessible loss. No, it has to be against profit. If there's loss, then of course there's no way to claim allowance. Okay. So unutilized allowance can be carried forward indefinitely, except in case of permanent cessation of business. So we are saying that if, like this condition 2 now, you have a loss instead of a profit, it means that you cannot relieve or you cannot claim that particular allowance. You can carry it forward to the next year, hoping you would have profit in the next year. Before, I think that there's a restriction before. I cannot really remember whether it's this one or loss relief. But now, you can keep carrying forward your allowance until there's profit to absorb it. But in the case of cessation, remember that in cessation, the business is no longer in operation. So of course there will be no next year or no other accessible profits for them to live in. So all we can do is to carry back. We call it carry back capital allowance. Carry it back to 5 years before cessation and go and relieve it against the profits. And the tax authority will refund you the tax that they have collected from you on that profits for those 5 years. But we're in Nigeria. We know that in Nigeria, this kind of thing is only in book. If you try it in real life, before you can collect your money, you suffer. So now, a formal claim must be made except where the revenue service deem it reasonable to grant relief. What I'm telling you here is that is your right. You have to claim it before you can you can absorb it in your profit. You have to write a written letter that you want to be claiming your capital allowance. So Jesus, something like that. Then number 5, the amount of capital allowance calculated is restricted to 66/3%. Please note the percent behind it. 66/3%, which is the same thing as 2/3 fraction of that percent of the accessible profits. So it means that when you calculate your capital allowance and you have seen the figure, like you have calculated your capital allowance, you still need to check, is this capital allowance more than 66/3% of my accessible profit? If it is, you restrict it to 66/3% of the accessible profit. The difference between your total capital allowance and the restricted figure will now be what you carry forward to the next year. But if the company is an agro-allied company or a manufacturing company, there's no restriction. But even though the park has put this thing, I think if finance 2023 has removed this manufacturing thing, I'll make my findings and get back to you guys, because I think it's only agro-allied industry now. I think manufacturing industry has been removed, but I will get back to you on it, Sha. So that's it for number 5. Number 6, capital allowance on qualifying capital expenditure incurred in generating tax-exempt income is not deductible from assessable profits arising from income not exempt from tax under SITA. For both taxable and tax-exempt income, capital allowance shall be prorated where the tax-exempt income constitutes more than 20% of total income of the company. Now, let's break it down. What are they saying? So what they are saying is that you have an asset, but your asset is generating tax-exempt income. It means that the income that you are getting from the asset is not even taxable. When the income is not taxable, why are you now deducting capital allowance of the asset from taxable income? I don't know if you guys are getting what I'm saying. The company has tax exempt, and there are some assets that are used to generate this tax exempt income. You cannot now remove capital allowance from those assets on income that is taxable. And this is if the tax exempt income constitutes more than 20% of the total income of the company, you will prorate the capital allowance. You will prorate them, which means that you will separate the capital allowance that is on tax exempt and the one that is not on tax exempt, and you use the one that is not on tax exempt for the company. Network is terrible. I'm sorry. It's just there's nothing we can do about the network. Okay, so now that's the proration of capital allowance. Do I hardly see this in practice, Sean? I hardly see questions in this. Capital allowance incurred by small companies are deemed utilized during the period such companies are tax exempt. This is how can I say it? Small companies are exempted from paying company income tax. So as long as you are a small company and you are not paying tax, your capital allowance is running, but you cannot utilize it. Like you cannot claim it because you're not paying tax. Then when you now start paying tax, you are not going to claim initial allowance. So what is law? Support law is not claimable. And you will count the number of years that you have spent as a small company. You will remove it from the economic useful life. It is the remaining years that have not expired that you used to claim capital allowance after you have become a large company. Please, are we good with all these conditions? Are we good with all these conditions? Is somebody raising up hand? Okay, sorry, I'm not expressing my cursor. So there's no response. So I assume that we are good. This class is dull. I'm feeling uncomfortable. Are we good?
Ma,
Can you call it a day? Yes.
I did not get the number 6, that part, that number 6, second to the
This
last.
number 6. So what number 6 is saying is that there are some assets that are used to generate tax exempt income. It's tax exempt income are income that are not taxable. Since we are not taxing the income that is coming from this asset, you are not allowed to claim capital allowance on those assets. But there are companies that in their total income, some of the income are tax exempt, some of the income are taxable. Now, for you now to know what to do, if the tax exempt income is more than 20% of total income, then you prorate your capital allowance, because it's still the same assets that you're using for tax exempt that you're using for the one that is taxable. Do you get? It's not like the asset is different. Look at in the first one that I said, the asset is different. But in this new one now, it's the same asset that you're used to generating both tax exempt and taxable income. So as long as tax exempt income constitutes more than 20%, you will prorate it. You will prorate it to the like percentage of your income. Tax exempt to 25%. It means that 25% of the capital allowance will not be claimable. Are we good? Are we good?
Yes, ma'am.
Okay. So
Yes,
should we
ma'am.
continue or should we call it a day? Because even the way this class is done, and we'll soon move to calculation. Let's finish this written aspect, please.
Let's
After we
call
are,
it a day.
let's finish it. So that in the next class we'll start with illustration. Can you see the illustration that we have? It's quite plenty. We cannot finish it in the next class, but wherever we do in the next class, that's where we stop. So let me quickly talk about higher purchase. Then we'll call it a day, please. I know you guys are tired because I can even tell from the way you guys are responding. I've already spoken about restrictions, part of the condition that I spoke about. So let's skip this. Then calculation of capital allowance on assets acquired on higher purchase. Remember that the cost of higher purchase is higher than the original price of the asset. When you buy things on higher purchase, they have added interest elements, right? So now, what are the things that you're not going to do?
Yes.
When you have an asset that has been purchased on higher purchase, mute your mic, but Ashika, mute your mic, yo. Who is that now? Okay, thank you. Oh, this is the last part. We can go after this one because even my throat is starting to break up. Okay, so number one, identify the interest element and remove it from the higher purchase price to get the true cost of the asset, because it is on the true cost of the asset that you are going to calculate capital allowance on. So you need to calculate the interest element. How much is the interest element? Identify the deposit, that is the amount that you deposited. Know that in higher purchase, you first deposit. After deposit, you now start paying instrumental payments. Identify the deposit and instrumental payments and their payment dates, which means that which dates did they pay deposit? Which dates are they expected to be paying what? Their instrumental payments. When will the instrumental payment start and when will it stop? This is what that number 2 is talking about. Identify the year of assessment and basis period that these two payments fall into. You know that some higher purchase can last for years, 1 year, 2 year, half year, So you need to know which year of assessment did the deposit and some part of the installment fall into. Which basis period did they fall into? For each new installment, treat it like a new asset was purchased, but deduct the number of years that has previously enjoyed capital allowance. All right, so this one we are saying that for each new installment in a particular year of assessment, we are going to be treating them together. Like it's not like we're not treating each installment, we are treating each year of assessment. Now, when we if we don't do calculation on this thing, you might not understand. It's going to be, and I hope this class will not be few when we do calculation because I will not go back. So what we are trying to say is that for each new year of assessment, you remove the previous year of assessment that we have done before. For example, the assets you are going to be paying for 3 years. In year 1, you pay deposit and like 3 installments. Year 2, you pay like, let's say, 6 installments. Year 3, you pay like 3 installments. So for year 1, of course, you do initial allowance, annual allowance for that deposit and the 3 installments. Remember that you have removed interest elements from those things. So year 2, you do initial allowance for only those 6 installments that occur in that year. Annual allowance for both the 6 installments and the 3 installment that is coming from last year and deposit. Year 3, initial allowance for only the 3 installments. I know it's going to sound like gibberish right now, but when we are doing the calculation, against network is not good. You know what, guys? Let's just stop here. In the next class, we'll start from this higher purchase and we'll do calculation on capital allowance. Okay.
Ma, please, I want to ask you something, please, ma.
Okay.
This new tax law, is there any change in this capital allowance? Did that affect it?
It's only the investment allowance. Are you talking about the new tax law that we just have? No, there's no effect. There's no effect.
There is no what?
There's no effect. The only place
Okay.
maybe might be affected is those small business. You know that the what we call small business has changed. Now small businesses those are earn below 100 million. Do you get? So now if you see that the company revenue is below 100 million, their gross income is below 100 million, you know that that company is not supposed to claim capital allowance. Do you get? That's the only thing
Okay.
that I can say that affect it.
Okay.
Yes.
Thank you.
So you see you
Okay,
guys next Sunday.
okay,
Okay,
sorry,
you have
please.
question?
Hello.
Yeah, I can hear you.
So, okay, sorry, thank you. So, I want to ask, which of the tax does it now affect? Does it affect business commencement or change accounting date or cessation?
No, it
And I
does
want to
not
ask,
affect
this
me.
this season that we did, is it based on the final 2022 or this new one?
Which
And
one?
as well,
Like, I don't get your second question.
this situation that we did today,
Okay.
is it based on the finance 2022, 2021, or this new one that just commenced
Finance
this
for
year,
2019.
2019?
Yes.
Okay, so does this new act does it affect any of
It
the
does not affect
commencement or
any.
comment change
No, it
or
does not affect
change
any.
accounting date?
No, it doesn't.
So our change accounting date is still like identify the year of accounting change, year that comments change, and
Yes.
also the next 3 years, next 2 years
Next years,
using
yeah.
old rule, using the new old rule and using the new rule. It's still the same
Yeah.
thing.
Yeah.
So I don't know. I've come across a question or a solution whereby this situation, instead of using that penultimate or ultimate year, they start from that ultimate year and they still maybe I don't really get it now. Whether they continue to do it backward or forward, I don't know. But they didn't do that only that first year. They didn't do that only that ultimate year. Is that they do backward tax or forward tax? That's what I don't remember anymore. But I know
Right.
that question I saw is not only the ultimate year they did.
In that scenario, I would advise you to check the year. What is the year of the question? Remember that finance at 2019 only affect years from 2021 upwards. So maybe the year is below 2021 and they will follow through then.
Okay,
Do you get? So that's probably the case.
thank you.
You're welcome.
Thank you,
Uh,
ma.
See you guys next Sunday. Please come with your look to say boost. So this one that the energy is reducing today. I don't like it too. Next Sunday we are doing calculation, so you need energy booster. All right, bye bye everybody.
Thank you so
Thank
much.
you so
Have a
much.
good night.
Thank you, ma.
Thank you.
If it's another person that was my question, the time the money was done. I just need all the time of brain that I need. Sorry to disappoint you. I just